So let's start. This episode is going to be about balance sheet, cash flow statement. What will be the change in balance sheet? What will be the change in cash flow statement? Remember that this is season 2 where we have taken some debt. The percentage of debt is written in front of you, that is 60%. So what we'll do is we'll make a new sheet, we'll name it as balance sheet. We'll make a balance sheet first and eventually we will talk about cash flow statement. Let me paste this. Okay, so and I'll just take I'll just start with the balance sheet. I was just covering that RNC sheets year 0 till year 6. Now I have this for my balance sheet. In my balance sheet, I'll start with the asset side. I'll say cash and I'll leave it blank. I'll say the fixed asset, that is the cart, and you guys know where I'm going to link it. My total assets will be same as before. I'll just link it this plus this, uh, and I can paste it ahead. So I understand that I'll have all numbers here, so I'll just select all of them. I'll reduce the decimals as well, and then I'll say equity capital and retained earnings, as you guys know. So this is the same as the previous balance sheet. The one new thing will be debt, and then I have total liabilities and equity over here, and I'll do sum of say these three. I'll paste it quickly, and what I have is I have a tool called check, where every time I try to match the balance sheet, if it is not matching, I am certain that there is some problem, some mathematical problem in my model. Now cart, where I'm going to link it, you must have guessed it right, in fixed asset schedule. Closing balance of cart. Closing balance, linking everything to closing balance is important because balance sheet is made at the end of the year. Equity capital, I know 40% of 20,000 I am raising using equity. So this multiplied by 40%, and I'm not raising anything again. That is the reason equity capital will remain constant, because we know that it's going to be cumulative. If you have any doubt in equity capital, you can go back to the previous one. And retained earnings will be cumulative to the previous season. You can go and then you can understand how equity capital, retained earnings, these things are linked together. So retained earnings done. Now debt. I know that debt will be linked to the closing balance of debt schedule. That is important to understand, that you have to link everything to the closing balance because balance sheet is made at the end of the year. Now this check is coming up because my cash is right now blank. Once I am done with cash flow statement, I'll be able to match the balance sheet. So what I'll do is I'll start making the cash flow statement, which is a part of fourth step itself. So I'll just paste it. So now we are going to work on cash flow statement. First will be cash flow from operations. I hope you remember, we are going to start with net profit. We are going to add back depreciation. This was covered last time. What about adding interest cost as well? Think about net profit. Once we calculated net profit, we actually deducted interest costs as well. Will you consider these interest costs as operating expenses? You might be, but it's much better. I like it this way, to add interest cost back and to then derive what is the cash flow from operations. We have one item left here, that is change in working capital, which will come in the next season. Now we have cash flow from investing also. We have capex, that is the purchase of cart. So that will be cash flow from investing. And then we have cash flow from financing, where we have debt raised. uh, Debt raised, this is new one. Debt repaid, this is also new because we are repaying the debt also, that is also one cash flow. And we have equity raised as well. We have dividends paid, but we don't need it right now, so that will be cash flow from financing. What I'll do is I'll add the three, that is CFI plus CFO plus CFF, CFO plus CFI plus CFF, and I'll make a small schedule of this. That will be big BOP cash, that is beginning of the period cash, beginning balance of cash is also okay, and then cash generated during the year, and then I have closing balance of cash, that is EOP cash. So you can name it as what you want. You can name it as beginning balance of cash, you can name it as closing balance of cash, no problem at all. Now everything you are going to link, uh, you are going to link to income statement and to balance sheet. So that's the beauty here. In cash flow statement, you need not to link anything to any other place. Everything you can link to income statement and balance sheet. So let's see how we are going to do that. I hope you understand linking cash flow from operation completely from income statement. Net profit can be linked there, depreciation can be linked. So let me start linking it. Net profit linked to PAT, depreciation linked to depreciation. I'm linking year zero, so I'm linking it in year zero. So you have to actually pay attention to this. Where are you linking it? And then cash flow from operation will be sum of all these three. I'll just format it a little. I know all these will be numbers and reduce decimals. I can simply paste this ahead. So this can go ahead and control R. Control R, you can use control R to paste. So this is how it looks. Cash flow from operations. Wonderful, right? CapEx. What is the CapEx that is done? So I can say change in fixed assets, change in fixed assets in balance sheet. Maybe you can say rather than change in fixed assets, you can say what is the change in gross assets rather than taking a difference over here. So what is the cash flow from investing? Cash flow from investing is basically which goes into fixed assets. So we are investing how much? We are investing 20,000. Where we can see that? We can see that over here that this is the purchase, this is the capex that is done, this is the purchase of the card. So I can simply link it over there. I can link capex to fixed asset schedule, which is actually not income statement or balance sheet, but yes, its capex is found in fixed asset schedule, where you can understand what is the purchase of the asset which is done only in year zero. Now I have debt raised, which I link to debt schedule. So my point was we are not going to link anything to the assumption sheet per se, and we will link debt repaid with a negative sign itself. You can do it with positive sign. I'm linking it with a negative sign. You can do it with positive sign, but then you have to do some changes. Now to link equity raised to balance sheet, I have to add work. So I'll do that. You'll understand why I did that. So to link equity raised, I'll go to balance sheet and I'll say that what is the equity capital here minus what was there initially. So I'll get 28,000, and then I can do sum of these three. So I wanted to use sum, that is the reason I use negative sign with debt repaid, so that it automatically comes. I can simply paste this ahead and I'll get cash flow from investing and cash flow from financing. So that is there. The change, you have to understand that the change in the previous season and this season is debt raised and debt repaid. I'll do CFO plus CFI plus CFF, CFI plus CFF, and I can paste it ahead, and then I'll just say that what is the BOP cash? Zero. Cash generated is this cash, and the EOP cash will be this plus this. Good. The EOP will go to BOP next year. I can paste these two ahead, and then I can paste all the three ahead. It's a little slow. I am a little faster maybe. The computer is getting heated up because this being made in the last I think 30 minutes. So done. We are done. We are here. EOP cash is here. That is the cumulative cash which will go to balance sheet. And once it goes to the balance sheet should match. If it doesn't match, then you have done some mistake somewhere, some mathematical mistake that we have to rectify. So it's not matching. What is the mistake that we have done? Can you guys think about it? So you, how to think about it? You can think about it using the difference. You can see that there is a 3000 difference here. Okay, so that is maybe because of debt, or is it because of and then the difference becomes constant when this is the scenario. So where is the mistake? So maybe we can go back and we can look at the cash flow statement once, that okay, what is happening here? Is it proper? Is it linked properly? Yes, things are linked properly, but still 3000 cash, which is which I have added over here to net profit. Do I need that in cash flow from financing as well? If you thought that initially, then while I was doing this, then that's great. So what I'll do is I'll add interest cost in this. I'll add interest cost. I'll say that I'll add means I'll say that it's outflow, so it will go negative. So I'll say negative of the interest cost which I have added there. Why did I add it there? Because net profit में से हमने interest cost हटा दिया था, लेकिन मुझे interest cost को cash flow from financing में consider करना था. That is the reason I did that. And now you can see that your balance sheet matches. Now you can become happy because assets equal to liabilities, and that's what is called happiness. So that was season 2 for you. Wait for season 3. It's going to be inclusive of the working capital part, because businesses are done on credit. You will sell on credit, you will create account receivables, you will purchase on credit, you will create account payables, and then you will, there will be some inventory or stock left over with you. How to account all those things, what will be the changes? So you can understand from season 1 to season 2 that the major change was interest cost here, the total debt schedule, and we have in cash flow statement we have added 3 different rows, and in balance sheet we have added only one single row extra from the first model to the second model. So if you found this difficult, then you have to go back to season 1 to understand the basics things again, and then come back and then get over these things, get over debt schedule, get over fixed asset schedule. It should be very clear to you, so that we will talk about working capital, which will also look really good to you after season 3. So after season 3, we will have 3 more items in balance sheet. One will be account receivable, account payable, and inventory. I hope you guys are excited, and if you are, please take the subscribers to maybe uh, what number? I don't know any number as of now, because I said let's be motivated on yourself rather than looking at the subscribers or looking at the likes or the comments that you guys do. But that shows your love, guys. Okay, so please show your love and please share as much as you can. Thank you so much. Thanks a lot.